I think it's pretty simple. Early on, what you saw was there was some expectations that not necessarily the Fed was going to immediately cut rates, but that the Fed was more open-minded. And if we did see signs of weakness and also concerns about the inflation environment, that the Fed stood ready to pivot. Certainly we saw that earlier this year, and then it was certainly something that was reinforced in June. But I think the second issue is when we had this little bit of back and forth with regard to the tariffs in Mexico. So obviously on Friday when we saw some movement towards resolution and obviously some follow through over the weekend, it means that one of the concerns about a broadening of these tariffs that go beyond just China and include our trade policy with Mexico and Canada, that was taken off the table, at least for now. So I think that's part of the reason why we're seeing better performance in June.
Jim, let me ask a kind of related question there. The Fed does seem to be sort of one of the activating factors in this rally so far. But as you look down the road, is it likely that we're going to continue to see the threat of tariffs, if not the imposition of tariffs, as one of the conversational items that is going to make the market vulnerable? In other words, the president is going to threaten tariffs against who knows who, Europe, trading partners, China, and others, and that may be something that is a stumbling block for higher stock prices.
I do think that's true, Tyler. We're going to see a bit of a jagged rally through the end of the year and into next year with improving growth and a relatively low interest rate environment, buffeted on occasion by the trade risks that you raised. So while it's a positive development that we've dealt with the short-term Mexican trade issue, we've got to pass the USMCA, and the Chinese trade negotiations are going to be going on not just for this year, but probably for years to come.
Mike, in your view, if there is no deal with China, or depending on what happens with the G20, does that influence your view as to whether or not the Fed cuts interest rates in July or later this year? And I'm asking you this because the markets seem to be rising with every passing day that it believes that there are going to be rate cuts.
Well, first of all, I think what you talked about is very conditional. That is, if we were to see a complete breakdown in terms of the negotiations in the U.S. and China, and we saw no pathway towards a resolution, what you'd certainly see is the economy would be impacted by that, and I think that would wind up prompting response by the Fed. But I think we have to be careful here. I think the base case for us is that there's going to be this back and forth with regard to trade. We're not going to see this definitive resolution reached at the end of this month. In fact, it's going to be a lot of back and forth. But that we ultimately think the two sides will come to at least an agreement in terms of working towards a framework towards a trade accord.
So, Jim, where, if you had some incremental money, would you put it to work right now?
So I think U.S. high-yield bonds look particularly attractive. We have a lot of clients who will say we've had money on the sidelines, we want to go into the market, but we're worried about losing it. You've got much better downside protection in high yield versus equities. During the 19% sell-off in the fourth quarter, high yield was down 6. During the recent 6% decline, high yield was down 1. And we think you can get a return, say, of the 7% range over the next 12 months. So that would be destination number one for fresh money coming into the market.
Fantastic.